Time now for past picks with Jerome Hass. So we're going to go back to these picks were on February 21st of 2025, so just about a year ago. Your first one is Mainstreet Equity. When you recommended it, it was at $200.78. Now it's at $108.25. So this one maybe didn't do as well as you expected. Are you still holding on to it?
We still hold on. It's still one of our largest holdings. And, I think the sentiment on a lot of REITs, especially those in apartments, has been impacted by the lower levels of immigration in Canada, and especially the lower student levels. And I think that it's pulled down Mainstreet as a consequence for that. But Mainstreet has not had a decrease in their rents, unlike the headline figures which you see for most of the apartments and the numbers that you see from StatsCan coming out. And the reason for that is that they're really focused on affordable rentals. And so the average in Canada, well, in Toronto, is $2,100 for an apartment here, the latest numbers, and their average is $1,250, and they're primarily focused in Western Canada. So it's that affordable segment there that really still has a lot of scarcity of demand. So as a consequence for that, they were able to raise their rates over the past year. Their numbers came out last week for their quarter. I think they raised them about 2.5%. The free funds from operation were up about 7% last year over year. So they're able to buck the trend that's been out there. And the other thing about Mainstreet is that they're now preparing to invest counter-cyclically. So they've got about $800 million in liquidity that they're going to go out and purchase rundown apartments. That's their mode of operation. They fix them up, put them back in the market, and all of a sudden something that was run down is now in the mid-market, as they call it. And we think it's ironic that the federal government's actually going into competition with them, because they, through Build Canada Homes, is essentially trying to build affordable housing. The problem with what they're trying to do, and these guys are in direct competition with Mainstreet, is that they're doing new builds. So if you do new build for affordable housing, it's going to cost you about $400,000 per apartment. Conversely, they're buying rundown apartments, and they pay on average about $125,000 per apartment. So they fix them up and they can put them on the market for $1,250. The federal government, assuming they're going to be as efficient as a private builder, which we've seen from recent pipeline successes, is maybe a stretch. But it's going to cost you about $3,000 a month to justify the expenditure. So either the federal government's going to have to subsidize these, or I don't know how it's going to work, but I think they're better off just buying shares of Mainstreet.
And so you expect maybe long-term the shares of Mainstreet to go up? Because I'm just looking, just 2 weeks ago, Mainstreet was up the most it's been in 16 weeks. So obviously doing maybe a little bit better.
Yeah, no, it's been a phenomenal success story. So they've been listed, I think, for 26 years now. They've never raised any money in public, or any equity since the IPO, and they've grown at 18% a year. It's a great long-term success story. And now, because they're so loaded up with liquidity, they're going to counter-cyclically invest, because they're getting bargains out there. They're going to grow the business much stronger organically than they have in the past.
Interesting. Okay, next past pick is